N. Knowledge of cost accounting principles, e.g., costs throughout the production process, fixed and variable costs, cost allocation contribution margins, etc. FP&A analysts must understand how costs are incurred, measured, allocated, and controlled throughout operations. Cost accounting supports managerial decision-making by providing detailed information about production costs, operational efficiency, pricing strategies, and profitability. Unlike financial accounting, which focuses primarily on external reporting, cost accounting is designed for internal management purposes and operational analysis. FP&A professionals use cost accounting information to support budgeting, forecasting, variance analysis, and strategic planning activities. Effective cost management improves profitability, resource allocation, and operational performance, while helping organizations remain competitive in changing business environments and economic conditions. Costs are incurred throughout the production process as organizations acquire materials, utilize labor, and consume operational resources to produce goods or services. Cost accounting categorizes these expenditures into direct and indirect costs to improve financial analysis and operational control. Direct costs, such as raw materials and direct labor, can be traced directly to specific products or services. Indirect costs, also called overhead costs, include expenses such as utilities, maintenance, supervision, and factory rent that support production activities but cannot be assigned directly to individual products. FP&A professionals analyze production costs carefully because understanding cost behavior and operational drivers improves pricing decisions, profitability analysis, budgeting accuracy, and strategic resource allocation across business operations. Fixed and variable costs are fundamental cost accounting concepts because they influence operational leverage, profitability, and financial planning decisions. Fixed costs remain relatively constant regardless of production volume within a relevant operating range. Examples include rent, salaries, insurance, and depreciation expenses. Variable costs fluctuate directly with production or sales activity and include expenses such as raw materials, commissions, and shipping costs. Understanding cost behavior allows FP&A professionals to perform break-even analysis, evaluate profitability scenarios, and assess the financial impact of operational changes. Mixed or semi-variable costs contain both fixed and variable components, requiring additional analysis. Accurate classification of costs strengthens forecasting reliability and supports strategic decision-making related to pricing, capacity planning, and operational efficiency. Cost allocation is an important managerial accounting process used to assign indirect costs to products, departments, projects, or services. Organizations allocate overhead costs to improve profitability analysis, inventory valuation, pricing decisions, and operational performance measurement. Traditional allocation methods may use labor hours, machine hours, or production volumes as allocation bases, while activity-based costing allocates costs according to operational activities and cost drivers. Activity-based costing often provides more accurate cost information because it reflects how resources are actually consumed throughout operations. FP&A professionals use allocated cost data to evaluate product profitability, support strategic decisions, and identify inefficiencies within business processes. Effective cost allocation strengthens financial transparency and operational accountability across organizations. Contribution margin analysis is another critical cost accounting principle because it measures the amount of revenue remaining after variable costs are deducted from sales. Contribution margin helps organizations evaluate product profitability, pricing strategies, and break-even performance. A higher contribution margin indicates that more revenue is available to cover fixed costs and generate profits. FP&A professionals use contribution margin analysis to assess product lines, customer profitability, operational efficiency, and strategic investment opportunities. This analysis is particularly useful in short-term decision-making situations such as special pricing decisions, product discontinuation evaluations, and capacity utilization planning. Contribution margin ratios also support financial forecasting and operational planning by illustrating the relationship between sales activity and profitability. Modern organizations increasingly integrate cost accounting principles with technology systems, enterprise resource planning platforms, and advanced analytics tools to improve operational visibility and financial decision-making. Automated systems enhance the accuracy, speed, and consistency of cost tracking, reporting, and analysis across departments and business units. FP&A professionals combine cost accounting information with operational metrics, forecasting models, and performance dashboards to evaluate strategic opportunities and improve organizational efficiency. Strong understanding of cost accounting principles enables finance professionals to support pricing decisions, profitability analysis, budgeting, and long-term planning activities effectively. Mastery of these concepts strengthens the FP&A function's role as a strategic business partner focused on improving operational performance, profitability, and sustainable enterprise value creation.